Hello, welcome to the Economic View, the last Economic View for this year, in fact. So thanks for joining us all through the year. And I'm joined as always by Evan Lucas, our market strategist.
Merry Christmas to you, Tony.
Thanks, Evan. I'm sure it will be.
Should be.
Now, for the last one, the timing's actually perfect in the sense that the government has just put out its mid-year economic forecast and outlook yesterday. And I wanted to talk about that. Some interesting numbers in there, and
that's one way of putting
interesting
it.
things.
Yeah, it's one way of putting it. It's,
what was your take?
All of the good stuff, inverted commas, was leaked over Saturday. So nothing, from my perspective, therefore, was a surprise. Yes, the budget's improved by about $9.3 billion, and the expectation to surplus is going to be slightly faster again. From a pure economic point of view, that's a positive. You've already seen in the last sort of 24 hours, S&P and Moody's say that with what's going on and the way that they're forecasting the budget's been run, they will hold on to our AAA credit rating. Okay, tick, fine. There are some parts of it that you just sort of like, okay, they've benefited clearly from increases in commodity prices. Yeah. They have clearly benefited from the employment boom, something that we've been talking about, the fact that they've managed to pick up more receipts off the back of what has been basically the best year of employment growth since 2005. Although wages aren't there, there are more people employed, therefore they're getting more personal income. Savings was a bit of a question mark, depending on which side of the political divide you sit on. I don't really want to get into that because it's not really that important from what we're talking about, but it was okay. I think that's the only way I can answer it. It's a good result for what it is. It's not going to blow anything out of the water. It's certainly not a surplus creating budget. And not only that, what they're talking about is they're trying to divide it up into two parts, which is basically normal government operations and then other materials, things like infrastructure spending and blah, blah, blah. You put them together, things aren't that fantastic. If you look at it purely from the government sort of normal side, that's where they're getting positive and they're moving towards what they call operational neutral, almost positive. Pros, cons.
So the numbers were better than announced in the budget, and that's largely because they weren't expecting iron ore to kick up as much as it did during this year.
That's why I think you can probably give it a pass mark. I think this government and the previous one as well consistently do what firms do, which is to probably underestimate and then over-deliver on that space. And I think that's been fairly consistent with what they've done. Looking forward, the more pessimistic sort of perma bears out there are looking at their forecasted numbers and saying they're rubbish. They're probably, again, about par. If you want to look at it, maybe you can argue their GDP figures are a little bit over-optimistic. You could possibly argue that their employment numbers are slightly optimistic, but on current trend, it's pretty easy to see it being reached, to be dead honest. So, yeah, the iron ore price is part of it. Coal and copper are also part of it. The question, therefore, is does it flow through all the way through to the May budget? Looking at the market and looking at the current geopolitical and macroeconomics, it will. And I think that needs to be part of this. So, the old adage is that for every average US dollar per tonne in iron ore adds about $250 million to the bottom line. They've moved it up to 59 average. It's already averaging 62 this year. The way things are going, it will probably drop back to 60, but it will by May probably hit 63, maybe even as high as 64. So there's already a win there. So it gets back to your question. Yeah, commodities are certainly helping.
Yeah, and when you look at those things, whether it's the budget or the mid-year statement, really you have to sort of move past that and say, well, what's really happening in the economy here? Wages growth still the issues there, and really ultimately, without that wages growth, people just aren't going to have the spending power, the confidence to spend, as they would need to really sort of get the full effects ramping right through the economy into retail and other sectors.
Yeah, and this is the catch, I think, with not just Australia but globally, is this two-tiered, two-speed setup. So growth is good. Growth looks like peaking in 2018, and most economists are forecasting that. Business confidence and business conditions are really strong. Profits are good. growth looks really quite assured. However, as you said, wages are the problem. So there's confidence on one side of the economy, but not on the other. We here in Australia are more skewed to a consumption-based economy rather than towards a manufacturing services-based economy. If you look at the overall GDP picture, although private spending is picking up, the issue is that, as you said, it's not filtering through. If therefore, going to the other side of what we're talking about, we've been talking about fiscal policy, let's talk about monetary policy. It's why we've been saying for the last 6 to 7 months that monetary policy is out of the question. The ability to change it looks very, very unlikely. If inflation does materialise in 2018 in Australia, it will be very, very incremental, if at all. Maybe you could look to other parts of the world and that could be there. There's another interesting thing with what you're talking about is that there's all this push-pull factor, confidence, consumer spending, business stuff. If you compare us to the US and also to Europe at the moment, we're actually about to go through a period that we haven't seen in 18 years, which is where the Australian cash rate will be, sometime in 2018, lower than the US cash rate. The last time that happened, it pushed the Aussie dollar to 50 cents because the carry trade ran away. So the yield you get in Australia for your sovereign bonds is going to be less than the yield you get in the States. Now, the States is still seen as not only the beacon of growth, but the most secure sovereign nation on the planet for obvious reasons. And therefore, there may be some quite interesting market moves off the back of this as well. So that's another sort of just a bit of a conundrum, slight spanner in the works that next year could be from a market side is that the economics clearly say that the RBA shouldn't be touching cash rates, but the market might go past it from other parts of the world and create other sort of interesting diversions because a lower Aussie dollar is good for exporters. Gets back to your point about iron ore, is that if all of a sudden, yes, it might be 62 US a tonne, but if you've got basically doubling that in terms of the average price of the Aussie going to 50 cents. Now, don't expect it to do that, but thinking about it that way, there's another budget pop up there as well. And again, huge 2-speed scenario. All hypothetical, but it's certainly something to watch. And you have to go back to 1998, 99. And you would have heard John Howard talk about it at the time. It was a very interesting period that, yes, the currency was so incredibly low, but exports boomed off the back of it because we were getting such a kick from the currency being that low.
I was over in New York at that time and I can tell you it was pretty expensive.
Yep.
We'll sign off there, Evan, for the year. So thanks very much for being with us all during the year, talking about economics. And viewers, we'll be back with you in the new year as well for the Economic View. See you then.